Is what we are dubbing Super Central Bank Week, a huge rate of bank decisions, the rate of rate decisions is taking off. Everything from Brazil and Iceland to US and the UK. As Bloomberg's pointed out, policy will be set this week in terms of interest rates for more than half the planet. Very pleased to try and put it in some kind of context with Emirates NBD Chief Economist and Head of Research, Khatija Haque. Morning, Khatija.
Good morning, Brandy.
So let's look at the big picture before we look at some of the decisions that are most likely to affect us. How much divergence are we seeing at the moment from some of the central banks about where inflation is and where it's going?
So I think the broad theme is that global inflation is slowing. It has slowed, and the vast majority of central banks are done with hiking. There are a couple of exceptions, the Bank of Japan being the main one, where they haven't even started their normalization of policy yet. They still have negative interest rates. But most other central banks are saying, we've done enough, inflation is coming down, we're ready to cut, we're just not sure whether we're ready this week to cut. So I think that's kind of the big takeaway.
One of the things we've seen with this high inflation environment coming out of COVID over the last couple of years has been some almost philosophical economic questions, if you like. One being, are interest rate hikes the right tool to deal with high inflation? Has what we've seen in the US particularly proved us right, or is it more nuanced than that?
Look, I think it's probably the only real tool that central banks have. Now, obviously, monetary policy isn't the only thing that drives inflation, right? There is fiscal policy as well. There's productivity gains, there's demographics, there's all sorts of things. But central banks only have interest rates as their main tool. So where inflation has surged, they don't really have any other option but to hike rates. Now that inflation has slowed, it's questionable as to how much of that was due to the rate hikes and how much of it was just a natural slowing post the pandemic, supply chain disruptions, normalizing and things like that. But I think they're now at the point where they feel that they don't need to hike anymore. If inflation continues to slow, then they should be able to start lowering rates. But I don't think the Fed themselves have said they're not in any rush to do so. And so the question now is one of timing, and markets have been moving backwards and forwards about whether they think it's going to be sooner, which is where they were at the start of the year, versus where they are today, which is actually, in the case of the US, markets are not pricing the first rate cut until July now.
We'll get to the US in a second, but on the idea that, you know, we've asked some questions over the last year about using interest rates as a tool. What about the 2% target? Is it still valid?
I don't think central banks today should be asking that question, because if they talk about whether the inflation target is relevant when they are missing the target, then they're kind of undermining their own credibility. So I think the first thing they need to do is get inflation back to the target sustainably, and then they can talk about whether that 2% makes sense or not. I think the issue historically is that anything higher than, say, 3%, you actually risk inflation spiraling higher. So 2% is kind of it's not zero, you need some inflation, but you also don't want it to be at the cusp of where it could accelerate out of control. You kind of want it to be somewhere where you can keep it at that point for an extended period of time.
Well, the US now sitting about 3.2. Is the last mile the hardest?
I think so. And certainly the data suggests so. We've seen the last couple of months the pace of disinflation slow quite sharply. And I think that's one of the reasons why some of the policymakers may be a little bit more reluctant to rush into cutting rates. They're not sure whether they have done enough, whether they perhaps need to keep rates high for longer in order to get that last mile back to target.
Okay, well, let's look through some of the banks themselves. You've mentioned the Fed a couple of times. That's Wednesday. You said July. We've been saying June up till now.
Well, markets were saying March at the beginning of the year, and that's steadily been pushed back because growth has been quite strong. The labor market is very robust, and inflation hasn't really come down as quickly as it did last year. So it's kind of stagnated a little bit. So markets are repricing, and they're now saying July is the first full rate cut. Obviously, it could come before then. We're sticking with June at the moment. But markets will look at the data and say, well, this isn't really enough for the Fed to cut. I think the key point for this week's meeting is more what the new economic projections are going to be from the Fed. So they publish those on a quarterly basis. And with those economic projections come their new interest rate projections, the dot plot. And so that potentially could actually go from showing 75 basis points in cuts over the course of this year to 50. Because policymakers in December were quite evenly split between 2 or 3 rate cuts, 50 or 75. If 1 or 2 of those who had voted for or thought that they would vote for 3 rate cuts now change their mind and say, actually, we may only do 2, then the median forecast changes, and that potentially could cause significant repricing in markets as well.
What would that mean for us?
Well, it would mean potentially we don't see as many rate cuts as we thought we would. So we have 75 basis points penciled in the second half of the year, and we may not get that. So it means interest rates stay a little bit higher. Things are more expensive for consumers in terms of borrowing, and businesses also have to pay higher to borrow from banks.
Are you getting any sense at all, and I realise you've got a massive Chinese wall between where you work in the research and treasury and the rest of the bank, but in terms of feeling on the ground that those higher interest rates have affected business borrowing and therefore business growth?
So when we look at aggregate data for the UAE, business loan growth has been pretty sluggish. All through last year, it was sort of low to mid-single digits. So I do think businesses are looking at whether they really need to borrow at these high rates, whether they can use their own cash generation capabilities to fund whatever expansion they need. Some of them are paying down expensive debt and they're building up deposits. So in the UAE, at least, yes, we have seen fairly weak demand for credit.
Got less than 2 minutes left with you, and we've got nearly a dozen central banks. Japan on Tuesday could see the end of the world's last negative rates. Pakistan today after a visit from the IMF, the UK, some European countries as well. What will you be watching the closest?
I think Japan is quite key because that is the last central bank to potentially move to positive rates. So that would potentially mean, that the interest rate environment is now going to be higher going forward. That's a significant change from where we were post-financial crisis. And then I think the UK is interesting as well because their inflation has actually come down quite quickly. So the central bank potentially could start easing sooner. But there again, they're worried about wage growth. They're worried about a tight labour market and the fact that, inflation may come roaring back if they start cutting too soon.
Khatija Haque is the Chief Economist and Head of Research at Emirates NBD, speaking to us on Super Central Bank Week. We just made that up, but that's what we're calling it from now on. A huge amount of rates policy that's going to be set this week.
Dubai Eye 103.8.
Join the conversation.